Hey, what's going on, Cashflow hackers? It's Chris with Life 180. This video, I'm going to be reviewing a video on Index Universal Life from Family First Life. Now, if you're not familiar with Family First Life, they are a simplified issue company that is now branching out into the Index Universal Life industry. They have partnered with Ethos and started selling a simplified issue. More, not even simplified, that's not the right way to put it. It's more of an express issue IUL product. And I've done another video on this, and they've ultimately been talking about the fact that, well, everything I've seen on this to this point in time has always been not what's in it for the clients, but what's in it for the agents. It's all about making money and building your team so they can make money. I've seen so many situations where it's like the wrong use case of a product, and it just is pretty much atrocious what I see with this product and how these guys are doing it. And as critical as I am of people in the business selling Index Universal Life the wrong way, I just couldn't go any longer and not make videos expressing this, because there's tens of thousands of agents out there selling these in a way that most people don't understand. They don't even know what they're doing. And in the videos that I'm even seeing for training from Ethos going down, it's tragic what I see is happening. So if you are somebody who is interested in having any review, I would encourage you, if you have an IUL, you have an illustration for an IUL, you're interested in giving a review on if it's right or wrong for you, you can go down to rescuemyiul.com, and we are happy to do a review for you. But without further ado, I have not seen this video. I had somebody send it to me and said, I need to do a review on it. As I try not to watch any of these videos ahead of time, because I want to be completely authentic, completely just kind of off the cuff to see how it goes. So without further ado, I am going to pull this up, and we are going to we're going to play this video, see how it goes. Let's roll.
All right, guys, welcome to Simple Retirement Solution, part of TNL. We got a special guest this week from the SRS headquarters, Bridget Reimer. How we doing?
I'm doing pretty well. How are you?
I'm doing awesome. Now, did I say your last name right? Is it Reimer or Reimer?
Reimer, you got it
right. I was right. Look at that.
Other way.
Nice. All right, Bridget Reimer. Well, thanks for joining me today. And you guys have noticed over the past couple of weeks, we're really kind of starting this, I guess, ground level approach to SRS. We want to kind of bring it back to the basics. We had Danielle Byrne on a few weeks ago with just basic concepts. Last week we had Brad Allen on, who did a great job of breaking down how simple annuities really are. We talked about two use cases. We talked about the lifetime income rider, and then we talked about some bonus products. And each week we're going to progressively kind of get a little deeper, and hopefully you guys provide some feedback as to what you'd like to see and hear. So this week I decided to invite Bridget on, who runs the SRS division. I mean, way back from when it was AMS, even before it was even named anything. So Bridget's been involved in these, simple retirement solutions for about as long as we've been in business, probably even prior to that. So I figured who better to have on. So this week last week we did Annuities 101, we're going to do IULs 101. So we're going to take a good 15 minutes or so. I'm going to throw some questions at Bridget, but the goal today is really just to get you guys to understand how simple the IUL product is, a couple of use case scenarios, and then over the next few weeks, we'll talk more about selling them, what that looks like. But
all right, so that on its own is a little concerning to me, because I always say that challenge with IUL is a very complicated product sold as a very simple solution. And so the fact that he even starts with that is concerning.
So welcome, Bridget, and we'll hop right into it. So if you can, if I'm a brand new agent and I were to ask you, I have no knowledge of this, and I say, hey, Bridget, what's an IUL? Talk to me about what that conversation sounds like.
Yeah, so it really is a simple product. An IUL is a life insurance contract, right? So it's already stuff you guys are selling. It just provides two benefits within one policy. So an IUL, being a life insurance contract, first and foremost provides a tax-free death benefit, just like any other type of final expense or mortgage protection insurance you're selling. The additional layer to that is a cash value account. So when you structure them, you have one monthly premium that goes to pay for two benefits in one policy. And Mike, that's simply what it is. What you do with the death benefit or the cash value might change based on the goal of the client, but really it's a life insurance contract that always provides those two buckets to go into.
Well, I would say it doesn't always provide those buckets, because how you structure it can be negligible on the cash value side. But it's not as simple. I'm curious to see how she keeps going.
Got it. So one payment, two buckets. One is essentially just cost of insurance, right?
Yep.
And
tax-free death benefit.
Yep, for your tax-free death benefit. And we've seen, like any of you guys that have been in the field and have uncovered policies, you'll Unfortunately, you'll find a lot of these IULs set up improperly, I guess, right? Yep. Where it's a minimum premium. And and if you're doing a minimum premium, Bridget, that's only covering the cost of insurance, correct?
That's right. Yeah, you've dropped your premium down to pay for the one benefit, so the other one's going to suffer, right?
Right. And if they're set up that way, I mean, how long do they last typically? I know each company's a little different, but.
Yeah, I mean, it really depends on how long you're going to pay, right? Yep. So the death benefit premium, the amount of premium that goes toward the death benefit is going to increase a little bit each over time. So if you're paying one price, eventually that policy is going to lapse.
Right.
And the idea is to hopefully stop paying on them. Well, if you didn't build it right and you only paid the minimum, there's no cash value to then make that death benefit last, right? So you're going to be tied to that payment for life, forever. And eventually your cost of insurance gets to be way too much and it lapses, right? It lapses prior to age 100 for sure, right?
Yeah. And so with that, what she's saying, I'll put it in technical terms for you. They use inside of Index Universal Life, they use what's called an annual renewable term chassis. So every single year you have term insurance for the amount of death benefit that you have. There's a term insurance product that's associated with that on the back end of the Universal Life policy. That's what it is they use that annual renewable term. So every year, you're guaranteed your insurable rating. Like, let's say you've got a preferred rating, you're 30 years old, get a preferred rating, you got $1 million of death benefit. Well, that $1 million is there. And when you're 30 years old, $1 million of annual renewable term is pretty cheap. And so therefore the cost of insurance is cheap. Next year, it gets a little more expensive and then a little more expensive. It's not super prohibitive until you get into your 50s and 60s. And then the costs go through the roof. But the challenge that I see, and I'm going to be curious to see if they address it at all, the challenge is the cost of insurance gets so expensive when you're in your 60s, 70s, and then 80s, when ultimately you're needing to rely on this for retirement income, the way that these IUL agents sell it, that the wheels typically fall off. Now, they all say as long as you design it right, structure it properly, use increasing death benefit while you're accumulating money and funding it, and then reduce it to a level death benefit when you stop funding it, it solves all the problems. But honestly, nothing could be further from the truth. It doesn't work that way. Anyway, let's see how they get into it.
And probably way sooner than you would think, even if you continue to make the premium. And that's the sad part about those policies that have been built the wrong way, is you could be making your monthly premium, and by the time the cost of insurance gets to be too much, it's not enough, right?
Yeah.
So unless you can fork out more money, it's not going to last.
Right. I mean, and if you're setting up a client that way, you're better off just doing a term or whole life or something else, because absolutely. Exactly. And so that's not the way we set them up. We're not out there selling minimum, I remember so vividly, every time every time someone told me, Bridget, I have a $200,000 whole life policy and it's $50 a month. I go, oh, you have an IUL set up wrong, right? Yeah, and then you pull it out and it is, right? Or it's some type of UL that's set up because a lot of agents make that mistake of going, I have a whole life. And we'll talk a little about, you can structure these to cover someone for their whole life, but it's not just a whole life product, right? It has to be set up the right way. So I think we all understand the cost of insurance, and that's just like most of our products, right? It's based off of age, health, whatnot. There's simplified versions. There's some underwriting. There's non-med underwritten. So, but the key is that one bucket, if you will, when you make that payment, is cost of insurance. But where we use this to be.
And by the way, how he just described that, I got to give him credit. I don't know where he's going to go with this, but how he described that component of it was better than most IUL agents that work for these IMOs do. So kudos to whoever this guy is.
I guess where it becomes a retirement solution, a simple retirement solution, is where you utilize that second bucket, right? Where it's a cash value investment. So can you speak a little bit to that bucket, what that does? How involved is that in the market, if it is at all? And then we can get into some of that tax-free benefit on the end.
Yeah, absolutely, Mike. And so that's what I was going to say too. So you now know what an IUL is in its product essence, right? And then it usually goes to serve or solve three different needs, really. More death benefit, that cash accumulation you're talking about. And then I would say the third would be like a long-term care alternative, which we can go into accessing living benefits. But to hone in on that second need, which is the cash accumulation, and I would argue that's what most people are doing the IUL for, building that correctly. So you have your minimum cost of insurance, which that's the minimum your premium has to be, right, to keep the death benefit afloat. You then are putting in an amount above and beyond that in one payment. So let's say your payment is $250 a month, right, Mike? Let's say $100 of that.
And by the way, he alluded to it, but he didn't go deeply. When you pay just the minimum, eventually the minimum is not enough. The minimum is not the minimum for your insurance throughout your life, throughout the entire contract of your life. The minimum is basically the minimum funding required to keep it in force long enough to not cause a problem on the policy lapsing too early. But the bottom line is, if you fund it at minimum levels, it's not going to last very long. So make sure if you are buying an IUL policy, or even if you're designing these policies, you look at it and when you put the funded premiums in, you make sure that on the illustration, you look at the minimum funding, the target funding, and then the guideline level premiums, and you are comparing and making sure that the expectations of how you're funding are in alignment with those numbers. Even if you target fund a policy, which is the target funding is how the agent gets paid. That is basically the base of the policy that the insurance agent is getting paid on. So that's the number the commissions are derived from. So unless you've overfunded the target premium by a significant amount, you're actually going to wind up in a lot of problems. Unfortunately, a lot of these illustrations are showing if you just target fund it, they'll show great growth, great performance long-term, all this stuff, but it doesn't work out that way. And even when you overfund it to a great extent over the target funding, you run into challenges as soon as you start dealing with distributions from these for tax-free income and retirement. And so I don't know where she's going to go with that, but I just felt like that needed to be cleared up a little bit.
A month is going to pay for your death benefit. That means that extra 150 is dumping into that cash accumulation bucket, right? And so then how does that cash grow? That's where the I in the IUL stands for index, right? We're indexing that in the market. So the insurance company is buying those options on your behalf, right? So you're not directly tied to it, which is why you can't go down. Similar to annuities, you know what Brad was talking about last week. That indexing piece is the same for an IUL or an annuity. So if you can wrap your head around how cash accumulation builds,
it's the same and it's not the same, because with an annuity, they use the same indexing strategy, but the annuity indexing cap rates and assumptions are much lower than an IUL, because an IUL has surrender charges and other fees and levers inside of the policy that they can pull and lean on to control and manipulate the performance of the policy and to protect the insurance company. I'm not going to say they manipulate it in a bad way. I just mean they can kind of move things around as they need. They're not intentionally manipulating you to screw you as a policyholder, but what they are doing is they're going to move things around and move levers so they're not losing money. At the end of the day, the insurance companies get their number one obligation to all these with all these IUL policies is not to the policyholder, it's to the shareholders of the company or to the mutual policyholders, meaning the whole life insurance policyholders. If it's a mutually held company, there's a couple companies that are mutual policyholder companies that have whole life and IUL, and therefore their obligation is to meet and share profitability of the overall company with the mutual policyholders. That is never the case with an IUL. And with an IUL with a stock company, the obligation with a stock company is to the shareholders, not the policyholders. So there are a lot of situations in a lot of ways that these policies can underperform and that the insurance company can reduce the performance. So the one thing that is guaranteed is that your policy will not perform the way it's illustrated. And so you need to be very, very careful how it's illustrated and what you're looking at.
You've mastered both products, right? So yes, it is tied to the market, just not directly, Mike, which is why you can't lose money in an IUL.
You can lose money in an IUL. It happens all the time. They say you can't lose money due to market risk, due to market loss. You can lose money because of market loss. And I've done a lot of videos on this. I'm going to link at the end of this my IUL training playlist for anybody who is an FFL agent, WFG agent, PHP agent that is seeing me for the first time. You need to understand this IUL stuff before you get too far down this rabbit hole. This is scary. Even the way she just said that, these blanket statements to me are just not compliant. It's ridiculous.
So that portion every month that's going toward that cash value is compounding and building up in the cash value.
Got it. So we got this indexed bucket, the whatever is excess, whatever's above your cost of insurance is.
I do like his Star Wars shirt though.
Going in there. And then like we learned last week, the index, the way it works, if the market goes up, you share in those gains. You may not get the same return, right? Market's up 50%. I don't think IULs are paying 50%. I mean, right. I'm sure they do pretty well. I mean, what are some of the caps that you see?
Yeah, I was going to say, so I'll clarify that. That's one major difference on an IUL versus a lot of the annuities that we sell is we use a lot of uncapped, is what you would call an uncapped index in the annuity world. Well, an IUL is going to have a cap, right? Because it's first and foremost.
Not all IULs have caps. IULs have options without caps. They just probably don't represent those companies. The Ethos product that they're selling doesn't have a cap. Now, what I will say is whether it's a capped index or an uncapped index, it doesn't really matter. The bottom line, here's what I'm going to do. You know what? I got to do this because this is important. So what I'm going to do is I'm actually going to shrink this really quickly because I just feel like this is really important for people to understand. Is I'm going to go here and I want to start a thing. Let me go here. I want to talk to you about how IULs work. So basically, when you have an IUL, you have money that you pay the premium, right? So you pay the premium, right? So you pay this premium, and as you pay the premium, that money goes in, and some of it goes to the cost of insurance and admin fees and stuff of that nature, and some of it goes down into a cash value bucket. This cash value bucket then creates a rate of return, and that rate of return is, let's say, 4%ish. And so if you have, let's just call it $10,000 in a cash value bucket, that 4% is $400. So this $400 then creates what's called an options budget, right? So the options budget then is used to buy call options. If you know anything about call options, then you understand that how they work. It's a win-lose scenario. So what they're doing is they're taking this $400. This is how they say the policy can give you upside potential and downside protection, because they're buying a win-lose thing with this $400. They took the crediting they could have earned for you, they risked it, and basically based on the options budget and then the cost of options, because don't forget, these call options right here, all these call options have a cost, and this call is the option cost fluctuates, right? So options costs can go up, options budgets can go, call options, the cost can go up or down, the options budget can go up or down. And so what happens is, whether it's a cap or no cap, it doesn't matter. And the reason is because the thing that matters, like for instance, I'm gonna say it this way: you could have the S&P 500 index. Okay, what matters is the fact that you're buying options on this S&P 500 index, right? So the options budget is going to be, let's say it's $400, and let's say the cost, and that would buy you a 12% cap, right? Based on the call options, they could pay you up to 12% based on the cost of those options. Let's just say that. I think that's the number she used. Now, let's say we get rid of that and we say, you know what? We don't have a cap. There's no cap, hypothetically. They don't have this on their product with Ethos, but there are other companies that do. But the thing is, this no cap seems really cool, and the sales conversation to it sounds really appealing. But at the end of the day, it doesn't matter, because we're still dealing with the same $400 option budget and the same cost of the call option, whatever it is. And so at the end of the day, you may be able to have certain years that perform well and better than the 12%. But at the end of the day, on the long-term perspective, it's not going to perform any better than the 12% cap long-term, because we're dealing with the same options budget, the same call options, and the same index. Therefore, because of the fact that we're dealing with the same index, whether it goes up or down from a long-term perspective, when we average everything out, the insurance company, because of the options budget, because of the call options, they may put a no cap in here, but there are going to be other fees, charges, and levers that they can pull that will reduce the performance of this no cap over time to fall into alignment with reality based on the budget and the costs, right? So that's really important to understand. That's what I'm saying. These are highly complicated products that are sold as very simplistic solutions. That is my big problem with them. And the problem is that when you understand them, and unless you're an options pro, and when you start seeing how the loans work and the options work and where the real risks are in this is retirement, they're okay. You're not going to run into a problem with an IUL until you're probably 65 or 70. The problem is that's why people are buying them. My challenge is a lot of people are going to own these things for 20, 25, 30 years, trying to save up and get to retirement, and they're not going to know they have a problem until it's too late. And that is the challenge. Anyway, so hopefully that makes sense. If you have any questions, comment in the comment section below on that. like I said, I go into much deeper dives on that on my IUL training playlist. Check it out, and let's keep this show rolling.
Foremost, a life insurance product.
Right.
So they have to abide by those rules and regulations. So I think our highest cap right now, Mike, is a 12%. So we have up to a 12% cap on one of our popular IULs.
Got it. Which is amazing. I mean, so
yes,
the best
really
case scenario, you're getting 12 points. But the key is this. It's not about it's about what happens in the worst case scenario. Because in the market, the worst case scenario is you lose all your money, right? I mean, you can, just like you can be up 50, you could be down 50. You could be down more than that. You know, I mean, I remember vividly, my dad, he's passed now, but when he was getting to that retirement age, it was when 9/11 happened, he lost over half his portfolio. He had to work an additional like 5 years just to try to recoup some of what he lost. But 401ks, they're not indexed. They're tied to the market, right? Up, down. Absolutely. So it's all variable, and we don't do anything variable license. So the worst case scenario in an IUL, you're just not gaining or losing. You just level off.
That's not true.
Flat.
That's
Zero's better than anything.
That's true to a certain extent. Once you hit retirement age and you start utilizing these for income, there's a whole world where you now have loan balances that are compounding against you. And on negative years, you have to pay the interest expense on those loan years, on the loan balances. And so what happens is that winds up decimating your account in retirement. You can have some down years when you're funding it if you don't have any loans against it, and you're going to be okay. As soon as you take loans from this, that's where the problem starts to exist.
Negative. And then the minute it starts going back up, because so in the long run, you see all these charts where index products are going to outperform the market. Just, I mean, statistically, look back historically, they do.
Yeah, and I think that's also in part, Mike, because you are
not if you add in all the fees and cost of insurance and so on and so forth. I will say this: I love indexed annuities, but I love indexed annuities not because of the indexed component to it. I love indexed annuities because the annuities are an insurance company product, and they offer riders that are income riders that guarantee income, that guarantee roll-ups, and guarantee bonuses that are going to get you more leverage on a guaranteed basis for your retirement income. Annuities, using the same index, it's almost irrelevant. You're utilizing it for the riders and the income riders that come along with them. It's not the same conversation, because when you look at the index performance, it's not the same index performance as the correlating IUL, and you have to. I would encourage you to think about, well, why is that? Why do they have the same index but different caps and different things for different products? And when you really break it down, you realize it's because IUL functions kind of like I just showed you. They have all these different levers that they can pull, have all these different fees and surrender charges. Whereas with IULs, they have to meet their promises and meet their guarantees, which IULs guarantees, if you look at the guaranteed column, it sucks. And so when you look at that, that's how they do it. They utilize those extra caps and extra like performance as marketing to be able to sell it, and then they reduce it as it goes, and it's just tragic.
Are locking in those gains as well, right?
Yeah.
So every year when it credits to you, you don't have to re-earn that. So the next year, if the market went negative, well, you're still at what you earned the year before,
right?
At least, right? So the power of the compounding and locking in of those gains, I think, is what eventually makes the indexing outpace all that.
Absolutely.
Yeah, and you'll notice when people sell IULs, they'll use the indexing strategy and they'll talk about, well, look at the historical performance of the S&P 500. But when you look back here, like I said, the S&P 500 performance has very, very little to do with it. The cap rates, the participation rates, you could have an S&P that performed at 12% every year with their 12% cap right now. But if the options budget goes down and the options costs go up, or any of that happens where the budget and you can't buy as many options and the cap has to go down. Well, and that's what's happened over the past decade. Caps have gone completely down. In the greatest bull market of all time, the IULs have not performed the way that they were sold. And so that is because all that's happening. So, that I don't know if my guess is, honestly, she just doesn't know what she doesn't know. She's probably been doing this for 3 years, has never really seen one of these things have to perform from a long-term perspective. And, all I can say is I've been doing this since 2009. I used to be the director of business development for one of the top IUL companies in the country. And the reason I stopped selling IUL is because of the fact that I used to believe like she believed. I used to think like she thinks. And I realized I was basically representing a lie.
Absolutely. That's a great point, because your money's in the market. There's no timeout. There's no stop. We don't stop. It's just wherever it's going, right? Yep, but like you said, every year you kind of freeze, right? You're up 10 points this year. Well, there's your 10 points. And then next year, it's a whole different. So whatever happened last year or whatever's going on this year has no effect on what you earned last year.
Yep.
With the market, it's just, dude, you're free fall, And I'm not saying markets, but there's clients
Careful
that,
with those statements.
we always ask, are you an investor or saver, right? If you're an investor, then dude, play the market. Sure. But those are not our clients. If the guy goes, hey, Bridget, this is just money I'm trying to play with. I'm going to invest and try to make the most money I can make. And if I lose it, I don't care. I'm not going to, right. I'm not going to send that to Ask a Specialist. It's like to just leave him alone.
Yep.
But if they go, hey, I don't want to lose any money.
Yes, I guarantee these guys know nothing about whole life insurance. And I can say that because that was me. And once I learned what you could do with whole life insurance, it's a completely different game.
This is all I have. I need to make the most out of it. Okay, now we're talking. Now we have a solution. So that makes sense. So, I mean, and they're simple, right? I mean, cost of insurance, investment, anything you pay above the cost of insurance going to go in this investment. It's index. Market does well. You share in those gains. Market tanks. You level off. You're capped at. I mean, the best one you said goes up to 12%. There's some all around, but the big point is you're going to make some money. You're going to share when the market does well, but you're never going to lose a penny. We're not securities licensed. We don't do it. So, I mean, if any agents have them, we're not selling those types of products. We're not. I always like to say, I'm not licensed to lose you money. Like that was I always told my clients. Like, what about I'm not even licensed to lose you money. It's a whole different license that I don't even want to learn how to get. I'm good. So that being said, if we can go through a little bit of use cases, right? I think one big, case and something that I do want to clear up any type of confusion is the tax-free retirement concept, right? Can you speak to that and what that really means? We're not saying that, you put your money here and just, it's tax-free. No matter, there's a certain method to, and there's a reason why there's tax codes, but because I think sometimes we start talking and we start confusing clients. You can take all your money out tax-free. Well, yeah, but there's a certain method in how that works. It's not just take your cash value out, right? Then the guy who takes all his cash value out and he goes, oh crap, yeah, now I get a tax bill. What am I doing? So there's the loans, and I'll let Bridget get into that. But I would, and you can, let us know the numbers, but I would assume a lot of these are being written for that reason, right? Tax-free retirement.
Yeah, absolutely. I would say the majority of our focus with the IUL is creating that, financial capital, being able to build something for retirement. I'm not saying there's not times where the IUL can be powerful for maybe an older client who's doing it for the death benefit. We can solve that. But I would say the majority of our cases are built for the cash accumulation because that really is the cool feature about an IUL.
Here's the deal. She's going to get into it a little bit. The fact that she's saying it can be good for somebody who wants accumulation, or that wants it for death benefit. The only way, in my opinion, that IUL actually can work is like a flexible, permanent term policy. As long as you don't leverage it for income and retirement, you can probably get away with it. As soon as you decide to use it for this tax-free income concept, that's where the wheels kind of fall off this product. And, I don't know. I guess I'm curious what she's going to say, but be careful.
The neat thing, right? And so how does that actually work? How do we get it to be tax-free? You're right. It's a very specific withdrawal method, right? We can't cash out the surrender value. We can't even take a withdraw against the surrender value technically. That would classify withdraw and be taxable if there's any gains in it, right?
Yep.
The way you do it for tax-free retirement is through a very specific loophole called policy loans, right? So they're not giving so you go in.
It's not a loophole. I hate it when they use lingo like that. It's not a loophole. It's a feature in the policy that is backed up by IRS code, but it's not a loophole. Like I cannot stand it when people try to position these things like they're secrets and loopholes. Like this has been happening for 180 years with whole life insurance and other policies, right? Like IUL comes around and you get all these influencers online and they talk about like, there's these loopholes and secrets. No, it's not. It's just, this is what successful people do a lot of times, utilizing whole life insurance. But the thing is, IUL agents are bastardizing all the success whole life insurance has had. I know it. I used to do it. And they turn it into these loopholes and catchphrases and marketing that mislead people. And to me, it's just sad.
You want to start taking out $50,000 a year, right? You have a cash value, let's say it's $1 million, whatever. You're going to take out $50,000. You're not going to go process that as a withdrawal, right? Give me a withdrawal. On an annuity, it's a withdrawal. You're taking it out, it's taxable. On an IUL.
In an annuity, actually, it could be several things. It doesn't have to be a withdrawal. And so once again, she's just talking about things in absolutes, in direct comparisons that are not even completely true.
We get to borrow the money. They're giving me a loan and my collateral is that cash value, right? So there's a few moving parts there. One, you get the loan of $50,000 and you can spend it on whatever you want. That's your living expenses, right? And that's what you're taking it out for. it stays in that cash value as part of your indexing, and it's a loan. So guess what? They're charging you interest for that loan, right? But it's a very low borrowing rate. I think I just looked at one, Mike, the other day from Mutual of Omaha. It's like a 3 to 4% borrowing rate, right? But if these policies are averaging 6 to 7%, it's all paying for itself. Does that?
They're not going to average 6 to 7%. I got news for you. Not long term.
Make sense? So you're not actually paying the loan back.
And that's not a net. That's not what it's going to earn net. You know, even if the index did 6% on average over that period of time, and that's what it did, you still got to back all the charges and fees and expenses out of it. And remember, and the borrowing rates, probably, this is not her fault. This is a timing thing. I don't know how old this video was filmed or how long ago it was filmed, but borrowing rates have come up in a lot of these insurance companies. The other thing that I want to say to this is that they're talking about this Ethos product, and that's the big push that FFL is doing. That is an express issue. They're trying to get people answers in like the first 5 hours of submitting an app on policies. Any express issue policy is going to have higher cost of insurance because there's more risk to the insurance company. It's Emeritus that is the company that they're writing it with. And so therefore, you know, Emeritus is really big in the insurance IUL space. And so Emeritus is not going to take on unnecessary risk. So they're going to pass that along to these people that are going to be buying it. The agents are going to go sell it like hotcakes because they're going to qualify for the car that they can win. And the problem is they're going to go do that, and they're going to be selling these people these products that have a much higher cost of insurance, which is going to have devastating effects on the cash value of the people that want to utilize it for tax-free income and retirement. It's going to be worse than most policies. That is the problem. If anybody has, by the way, one of these Emeritus Ethos illustrations and you want to send me an illustration, chris@life180.com. I would love to do an actual review of one of these policies.
The policy was built to self-sustain. So you take out the loan, which then it's just a loan. It's not reportable income. So it doesn't become.
It was not built to self-sustain. The illustration, if you understand the regulation of how IUL illustration law works, then you know that, well, I'll just educate you for a second. So in 2015, regulation AG 49 came out. AG 49 basically said, we've had so many problems with IULs being sold and not meeting up to their promises, lapsing, lawsuits, all these things, that we need to create regulation to rein in all the chaos and all the misleading sales tactics that are being put forward by these insurance companies. So they created regulation AG 49A. Insurance companies very quickly created a workaround, right? And so when they created the workaround, the crazy part is insurance companies create this workaround and then they create multipliers. Pac Life did this a lot. They create multipliers and other elements in the policy that allows it to still illustrate high, but it doesn't really increase the ability for this thing to perform long term. And so what happens is now they got around the original illustration. Well, 5 years later, after the regulation AG 49 came out in 2015, 5 years later, the regulators go, well, you know what? We're still having all these lawsuits and all these problems with these illustration warfare tactics and all these companies making promises that they're not keeping. So we got to update the regulations. So in December 2020, they updated it to regulation AG 49A. And so then companies immediately created workarounds to that. I equate this to the FBI chasing Capone back in the day. The government moves much slower than the company, than the person, than the individuals, right? So what happens is the government creates regulation, companies adapt really quickly, they find loopholes, they got really smart actuaries that know how to poke holes in the system and find ways around it. And so they did, and that's exactly what they did again in 2020. They created a workaround, they came up with other types of indexes and proprietary stuff that to get around it, and they still are able to illustrate really high, and they tout the fact that their illustrations are really solid. Well, guess what? In May of 2023, they came out with regulation AG 49B. I just want you to think about this commonsensically for a second. If in fact illustrations with IULs were realistic and they kept performing the way that they were sold, regulators wouldn't be changing illustration regulation to rein them in and get rid of the chaos the way that they are. There's going to be more regulation updates coming. it's pretty insane when you think about the fact that this stuff is happening and people are out there like her selling this in a way that they don't really even understand. I bet you, I don't even know if she understands the full history of IUL. I've lived through it, so I mean, I've had to endure it. But it's really, to me, it's sad to see that, you know, this stuff is happening this way, and that this is the way these products are being positioned.
A tax burden, right? It's tax free. And the idea is that you're simply just never going to pay back the loans because the policy.
Oh yeah, and that's the other thing on this. So she's going to say that the policy is always going to be earning more credits, earning more money than you're paying on the loans, and so that's leverage. The illustrations allow for 50 basis points, meaning 0.5% of positive arbitrage. Meaning, if you take a $1,000 loan, and you have a 5% loan, you're gonna have what, $50 in interest expense. Well, you're gonna get a 5.5% credit. That's what they show on the illustration, meaning you're gonna have $55 in credits. So that extra $5, not only does it cover your loan costs, but it gets you more money in the process, so you keep growing and compounding. It's not the way it really works, because in real life, they show positive years every single year on an IUL. The problem is 35% of the time, the market performs worse than the loan amount. Therefore, it performs worse. There's extra costs intertwined into this. When there's extra costs when you're in retirement, what happens is it drives up the net amount at risk. It drives up the fees. Those costs compound against you on top of the loan costs. These things implode, like they fold like origami, is the phrase that I like to use. So anyway, just please, I know I'm going fast on this technical stuff, but gosh, I can't stand watching people talk about this in a simpleton way, like, because they're trying to make it simple. I get the idea of sales trying to talk at a 5th grade level or lower, but come on, people, we're talking about your complete financial future, and you're talking about you as an agent having other people entrust you with their financial futures. Take that on with some responsibility and learn about this before you go and do what she's saying without understanding all of the moving parts.
Cash value is still earning, paying the cost of that loan, the interest, right? And then the rest of the interest is still going into the cash value, which then just keeps that building. Does that make sense?
Yeah. Yep. So it's a loan. It's no different than, hey, you go buy a car. You got to pay car taxes, but when you get that loan for the car, you're not paying taxes on the loan. You don't have to report that as income. You just have to pay it back, right? So this is the same. You're essentially taking a loan out against your own money, right? Because you have to have the cash value to take the loan.
Yep.
And there's, like you said, there's a small interest, 3-4%. But if these are averaging 6-7%, it's taking care of itself. Exactly. So there's no tax implications to the client. And as long as you're using that method. So no, you can't just take cash value out because that's taxable event, right? But so use the loans. And I guess so the question that, a lot of agents or clients would have is, okay, well, do I ever have to pay it back, right? And then let's say, and we set up a lot of these, right, where we're going to illustrate at, I'm putting money into this for 20 years and then I want to retire at age 60 and here's what I'd like to withdraw monthly. And we can illustrate all that for the client, right? Yep. So if I go to you and I say, Bridget, listen, I want to retire when I'm 60, 30 something now. And when I turn 60, I want to retire. And at that point, I think I'm going to need 10 grand a month to live on. You can illustrate this product where you go, okay, Mike, here's your death benefit. Here's what you'll need to put in to get to that amount where that's sustainable. So we structure all that. But then I go, okay, well, I'm taking loans out, Bridget, 10 grand a month, right? 120,000 a year. What happens when I die?
Yeah, absolutely. So there's one of two things happens, right? You end up taking out so much money, which shouldn't ever be the case, where the policy cancels, basically, right? You're out of cash value. You're not paying the loans back, right? You're not paying them back. And there wasn't enough to sustain the policy.
By the way, if what I'm talking about happens before you're 75, not only do you run out of money, but you wind up with a massive taxable event, because if you lapse the policy by taking too many loans before you're 75, not only do you wind up being out of money, but and owe taxes on the gains of your money, you owe taxes on all the loans that are due as well, and it's really not good.
Policy. That would be a really poorly built policy.
Right.
Okay. So it zeroes out. There's no policy left. As soon as that cash value disappears, right, you don't have a policy anymore, right? Because you're not paying premiums and you're not paying back the loans. So the policy simply implodes and cancels. You're out nothing. But let's say it was built right and you are taking your policy loans and you die.
There's nothing to do with how you build it right. You can still, a properly built IUL is not immune to lapsing in retirement because of the risks of market and loan exposure. Just like the fact that people like, I don't know if they're dumb or if they're just naive or if they're intentionally omitting it. I don't understand what's happening, but like the rise of people selling it this way is astounding to me. And it's like, it's borderline criminal to me, the way that this is being positioned.
You said you started taking loans at 60 when you retired, you die at age 88. If there is still that cash value and death benefit left, your beneficiary will get the higher of the two. It's typically the death benefit, right? Because remember, this product is first and foremost a life insurance contract.
Right.
So in order to be compliant and built out and stay out of, red flag area, the death benefit's always going to be higher. Well, then it does transfer as a tax-free death benefit to your beneficiary, because remember, it's a life insurance contract first. So you don't get both. I get that question a lot.
Yeah.
Like, people are like, oh, do I get to cash out? Does my beneficiary get the cash and the death benefit? No, it's all in one. The cash value is paying for that death benefit, right? So it's whatever the higher, which in all cases with an IUL is going to be that death benefit, because it has to be in order to
it's going to be the death benefit minus the loan value is going to be the net death benefit that you get. So they basically, when you take loans on it, it's guaranteed. Those loans are guaranteed by the death benefit. So you have to pay those loans back. So whatever the death benefit is, you minus the loans that you owe, the money that you owe on the policy, they're guaranteed by the death benefit. And if there's a net number above that, that's what you'll have left for a tax-free death benefit.
To follow the regulations. So tax-free death benefit, as long as there's money left. And if there's not money left, you were in trouble anyway. The policy imploded.
Yeah. And if that was the case, I guess the worst thing would happen is you would run out of your income. You wouldn't have to pay these loans back, right? Because essentially your cash value paid back the loans. There just wasn't enough in there to sustain the policy.
Exactly.
Unless it happens before 75, and then you get hit with a massive capital gains tax event.
Yep.
So you don't owe these loans at the end.
Exactly. The first thing the cash value is going to do is pay the interest on the loan, right? And remember, you're borrowing against your own money. So your only debt to that insurance company is the interest. You better believe they're taking their interest first, right? So the cash value is already paying the interest, and you basically cash out your own policy by not paying it back.
Got it. Yeah. That makes sense. I mean, it's simple. And like I said, it's what majority of the times that you're going to use an IUL, it's going to be for that type of setup. And, there's stuff you can do for, kids or whatnot, set them up for college funding. We'll get to that on some other weeks here on the training, but I really wanted to discuss that and just break that. And I mean, that's simple. It's a life insurance product, right? At the end of the day, it's still a death benefit, tax-free death benefit. It happens to have this indexed bucket where, there's two buckets. You make your premium payment. First goes to the cost of insurance. Anything above that gets invested. And then if you want to have this tax-free benefit, you're going to take loans out. You don't essentially need to pay them back. Your cash value is going to pay back the interest or whatnot. Like you said, you pass away, odds are death benefit's going to be higher than cash value. Your beneficiary gets that. So it still has that life insurance piece to it. I mean, it's a screaming home run for a product.
Yeah, they're really cool. They really are. Yeah.
And then I guess the last thing, Bridget, you are, like I said, you run the SRS team. And I know personally you've helped me with a handful of annuities and IULs. I don't sell nearly as much of these other agents. I mean, but as I had a license forever and I had a few cases and I remember you structuring them. It was so simple for me to understand. So I guess to the agent force, when would they reach out to you? What would they reach out to you for? And what does that process look like?
All right. So now they're going to finish with the sales pitch, and I'm not going to, give them the credit of kind of going on that path. So anyway, here's the deal: is these products are sold as a very simplistic solution, but they're very complicated. There's a lot of levers to them. There's a lot of layers to them, a lot of moving parts that are not in your control. I used to love IUL. In 2014, I moved away from IUL. I became a big fan of whole life insurance. And ultimately, at the end of the day, I think when you really dive deep into the marketing of IUL and where they get all their good marketing, they're leaning and stealing all the good parts of whole life insurance. They try to add on flexibility and tax-free retirement and all these things, replacing 401ks, which they shouldn't even be able to say because, and these guys didn't go too bad into it in this video, but I've seen a lot of other FFL videos where people are talking about it, and you're not licensed to be able to even do that. So like the fact that they're talking about that tells me there's a lot of illicit tactics going on in the back end. It's just really worrisome. I call it the blind leading the blind. I used to be in the IUL space. I think if you're an agent and you're looking to do this, I say, go watch my training playlist. I'm going to put up here in a second. Do a deep dive, test it, challenge me, push back at me, ask me questions. Like I do this to educate people, to save people from the mistakes that I made. And so if you have any questions, reach out, comment section below. Anybody that has any questions, want to share anything with me, need any help, email chris@life180.com. I'm happy to help any way I can. So until next video, have a blessed, inspirational day. Hopefully you found value in this. If you did, please like it, share it, subscribe, hit the bell, do all the things, and we'll see you on the next video. See ya.